Before we begin this podcast, we would like to remind listeners that NetWealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. NetWealth Investments Limited is the issuer of NetWealth financial products. For NetWealth Financial Services Guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's guest is a financial product issuer. NetWealth and the guest have a commercial arrangement that enables investment in products managed by the guest through NetWealth's platform. Under that arrangement, NetWealth may receive fees from the guest. More information about the fees NetWealth receives is provided in our financial services guide.
Welcome to the NetWealth Portfolio Construction Podcast, brought to you by the NetWealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives. In this episode, we explore the outlook for long-term investment returns in detail with Scott Fletcher from Russell Investments, based on their long-term investing report with the ASX. We really hope this conversation can provide some insight on some of the assets and strategies that may be worth considering for your portfolio and financial objectives.
Today we wish to share with you a discussion on the outlook for long-term investment returns and what investors can do about it in their portfolios. Joining us today is Scott Fletcher from Russell Investments. Scott is the Director of Client Investment Strategies and a senior member of the Russell Multi-Asset team. Russell was founded in 1936 and one of the largest asset consultants in the world, managing $390 billion in assets under management. With over 1,300 investment professionals in 21 offices around the globe, Russell are true multi-asset specialists. Scott, welcome to the podcast.
Thanks very much, Damien.
So we're going to start about a report that you do in conjunction with the ASX that you recently released on annual review on asset class returns. So what's the major outcome from this year's report?
Yes, the major outcome, I think, is twofold. One focuses on the returns that we've seen over 10 and 20 years, just to give investors an idea of the relative rankings of different types of asset class performance. The other thing, though, which has, I think, far more information in it, was about the variation in returns year to year, which has, as I said, a lot more information with regards to how should we build portfolios going for the next 5 years, looking forward to the next 5 years, and not just assuming that the past 10 or 20 will still be maintained going forward. So we found that Australian residential property, which would be no surprise to homeowners or investors in Sydney and Melbourne and places like that, was very much the top ranked in a performance standpoint over 10 and 20 years. Second place is where it gets a little interesting. So if you look at 10 years, you're looking at global shares and bonds on a hedged basis. And then if you look at 20 years, you actually find that Australian shares is a better performer than global shares. And this brings into view a lot of the variation that we see year to year. You'll find generally that the reason for residential property having such a performance advantage at times is not actually what a lot of people would, I think, necessarily think about. You think, oh, I'm just going to buy residential property because it's what I understand. I'm not so sure I understand what happens in the Eurozone or Brexit or Fed tapering. I don't understand any of this stuff. And property always goes up. So I'm just going to invest in residential property. When you look at it year to year, though, and this comes out in the report, you find that the biggest periods of outperformance are when times like the tech bust or the GFC, and it's simply because residential property has not fallen the 40% that the listed equity markets have. For example, it's fallen 3 or so. Whereas when you look forward from, say, the GFC, it's very rare that residential property as a aggregate, Australian aggregate, actually outperforms in a return sense global shares, hedged or unhedged. Very rarely does that happen. So again, it's quite a surprising result for some investors, I think, to find that it's not the stellar upside returns that outperform shares. It's actually the fact that it doesn't fall by as much when everything hits the fan.
So it's probably more about kind of that compounding effect.
Yep.
It's done well in periods where other asset classes haven't done so well, and it's probably some of that attraction to many people. It's interesting. Another part of, I suppose, with Russell, a big part of your job running multi-asset portfolios is so you've got a multitude of different asset classes to invest in from around the world. So then you have to start thinking about, okay, what's your forecast and your outlook for the relative asset classes? Because you've got choices for your multi-asset portfolios. So you think about return outlook and your forecast for those asset classes. What are the major trends that you're seeing with your own outlook to asset class returns?
Yeah, it's an interesting development over particularly the last 5 years. So the general, basic way of talking about it is when we came out of the GFC, we had a massive sell down in assets. And so there were a lot of asset classes that were extremely cheap, as you can imagine, having fallen 40-45% on the share market, for example. When asset valuations are quite cheap or attractive, that means that your upside is far higher. So if we take 2010, for example, we had 5-year asset class return expectations or forecasts that were actually quite high. And so to generate inflation plus 4%, you basically needed something like a 40-60 portfolio, 40% growth, 60% defensive. Marching forward to 2017, for example, between those 2 years, we've seen a significant rally, as we all know, in the equity markets. Now, the higher the prices go, and doesn't necessarily have to follow, but in this case, it certainly has, the more expensive the market gets, the less upside there is. And so with the rallies in not only equities but also bonds, we found that the traditional asset classes have actually become a lot more expensive than they have. So this means that your capital market forecasting assumptions since that 2010 sort of period have come right down. And if you look at share expectations or share market expectations, you're in the vicinity of 4 to 6%. If you're looking at Aussie shares, grossed up, you could hit the 7s. If you're looking at bond-type asset classes, you're looking at between 2 and 3%, which is significantly below the sort of double-digit returns that we've seen in the biggest bond bull market of all time. Because remember back, a couple of decades ago, we were coming off 18% type or plus interest rates, down to, in places in the developed world, 0 or negative even. That's very much a 2 to 3% sort of area in the fixed income side. If you're looking at infrastructure or alternative type of assets like that, maybe even listed property, you're looking at probably more like that 4% type level. So you can see that overall, if you want to hit inflation plus 4, and let's assume inflation's about 2.4, that'll give you a 6.4% return. Not much of what I've just described to you is a return above 6.4%. So when you put a portfolio together to fund a retirement, you've got this return gap.
So you're saying that if I hold the same asset mix from a couple of years ago, essentially I'm expecting lower returns. So I've got a couple of things I could do. I could really increase my risk profile and take on more risk assets. That might be a way to lift it. But for those who don't want to do that, we're looking at a return differential for a typical balanced investor, maybe say 2% less, that kind of thing. Yeah. So assuming investors don't want to change their risk profile, we've got this gap now. Is there any other mechanisms, means that you can look to kind of close that gap, to bridge that return gap?
Yeah, absolutely. So what we want to do is really build portfolios to do something about addressing that gap. And there's 4 main ways, particularly moving into a lower return environment. And when I say lower return environment, there is debate, as there always is in financial markets and among fund managers and economists over the next 12 months or so, as to the timing of when things start to hit the US economy in a negative way and so on. So pushing that aside, what there is far less debate about is those lower return expectations. So the 4 things we look at to bridge that return gap, first of all, one is very familiar to retail investors generally, which is I need to find additional sources of return. That's not just inside existing asset classes, but particularly in alternative asset classes. Yeah. So, and it's not even by the type of asset itself. It could also be trying to find additional return sources by the way that return is generated, the investment process used, or whether they go long and short, buy and sell at the same time, or whether it's a hedge fund type of profile. It's trying to find something that's less correlated to traditional asset classes so that if and when they fall, you've got something that's holding its ground or going up. That's the main one that most retail investors will be able to address. The other one, which actually, to be honest, has more bang for buck about it in terms of managing the downside. Managing the downside is important because the less you lose, the less you have to make in a lower return environment. So when I say about bridging the return gap, losing less or falling less is a very significant part of that.
Yeah.
So dynamic management and downside limitation strategies are two things that, yes, in the institutional market, we use very commonly, probably less available to retail investors. But I think dynamic management, the way we talk about it, is not your classic tactical asset allocation type of approach that you'll often hear about. The legends of funds management or something that's on the 7:30 report or in the financial press or whatever. That's not what we're talking about. Dynamic management is about dynamic risk management. So it's really a way of systematically taking risk off the table to lock in some of the gains that you've made during years where markets have done very, very well. But you need a disciplined approach to do that.
Yep.
And that's really important for retail investors. So you can try and make big market calls, but what we observe in the retail investors segment is that the cycle of investor emotions works not beautifully, but works very, very well. It's not beautiful when it doesn't work well. But it's actually very true.
Yeah.
So we have actually found, not only in Australia, but in global parts of our business, particularly the US market, that when markets are at a peak or at a peak in a market cycle, that's where we find retail inflows are at their maximum. And that's actually the point of highest financial risk. When markets are in a downtrend and they're coming into a basing turn, like at the low point, that's where we find redemptions are actually at their largest in the retail segments. And it's not just something that is specific to Russell mutual fund clients.
Yeah,
you see it across the board.
Yeah.
So getting back to the retail investors and what they do about dynamic management, you have to be careful that you have the capability and the discipline and the structure and the inputs to be able to not only make one decision, when am I going to get out of the market, but to make the second decision, which is when I'm going to get back in.
Yep.
And what we saw during the GFC was people get out of the market too late after a 30-40% fall, and then they'd just be so nervous and scarred by the experience that they would get back in after the market had recovered 50%.
And miss that rally.
It's for the average, I would say, everyday retail investor, that's something you want to treat with a lot of caution. Because when I'm talking about dynamic management from an institutional level, we have a whole range of resources and strategists and economists that we could back the truck up and get input from. But we have a very disciplined process to bring all that together and form a view.
Sure. And so just exploring a bit deeper on dynamic management, and you talk about a number of factors that are used, and you looked at retail flow as maybe one factor that you look at to kind of gauge sentiment and momentum.
Yep.
Any other interesting factors that you're looking at that will give you an indication of what to do for your dynamic management?
Yeah, absolutely. So you're really trying to break it into three time frames. So you're trying to break it into long term, medium term, and tactical or short term. Often the question, quite rightly, because it can be such a confusing topic, is what do you mean by each of those different time frames? So I'll spell it out. Tactical for us anyway is up to a year. When you're talking medium term, it's that 2 to 3 year period, investment horizon. And when you're talking strategic or long term, it's 5 years plus.
Sure.
That's the sort of thing.
Yep.
Now, there are particular factors that work very well in each time frame. And these are the three main things that we focus on. We focus on a lot of other things, but these are the three main things. Valuation is a terrible tactical signal. It is a terrible market timing signal, because it is a long-term fundamental view about the value of a company or the value in a particular asset class. That works beautifully in a long-term setting. So the valuation signals dominate our long-term analysis. In the medium term, we have things called cycle signals. And these can be things from where are we in the economic cycle? Where is the stock market in the earnings cycle? Where is government policy in terms of the monetary policy cycle? In other words, is the Fed or the RBA raising interest rates? Are they cutting interest rates? The cycle scores that we have, or the cycle inputs, are very important for that 2 to 3 year sort of horizon, and give us a feel for, are the current rallies or the current prices justifiable on the basis of what the cycle suggests we can see coming through in earnings for the next 2-3 years. The other one, which is very important as well, and is more of an entry-exit signal, is sentiment. And that's very much momentum type of indicators. It's very much overbought, oversold type. It's very short-term sort of market price action type of signals. So when we look at a long-term investment strategy, we're putting more weight on the valuation in the cycle, the medium and long term. So we'll put 80% weighting on value and 20% on cycle and nothing on sentiment. When we move through to a tactical decision-making time frame, because we do make tactical dynamic decisions as well, we will have more of a 40% weight on sentiment, a 40% weight on cycle, and a 20% weight on value. Value is still important, but it's very much a longer-term thing. So when we're saying markets are expensive, yes, on a valuation basis they are. Does that mean that they're going to go down immediately? No, because we need to take information from our cycle and our sentiment scores to make that assessment. So you can see it's all about the process that you have that backs your decision making and the rigor and the discipline with which you use that.
Earlier on, you touched on downside limitation as I suppose if we're in a low return environment, one way to I suppose plug the gap is don't lose money. It's a good start. Now, what are some of the things that you utilise, I suppose, within your process to kind of deal or improve the downside management in portfolios? Yeah. And is there anything that retail investors can do as well?
Yeah, there are a lot of sophisticated option strategies that we'll use, but when it comes to retail investors, I like to talk about 3 Ds of downside management. First D is don't pay too much.
Yep.
The second D is diversify. And the third D is downside limitation, like option strategies and so on. So we put a great emphasis on what do we do about our equity market exposure? So that's the dynamic management. The way that we implement some of those views is using option strategies. But the thing about option strategies, and obviously retail investors can access options via the ASX, and options on SPY futures and things like that from time to time. But the thing to note about options usage is there's a higher technical hurdle, so a higher educational requirement as to exactly what have you got. So when you talk to professional options traders, for example, we've all done high school maths and we've learnt Greek letters and numbers and stuff. If you overheard a conversation of options traders,
it's all Greek.
It's all Greek to me, sort of thing. Thankfully, it's not all Greek to me, but I'm one of the sad people who sort of understands it. But there is a lot of different risks in running an options book. It's not like you can buy an option and set it and forget it. So when you buy an option, it's a live thing. You need to manage that, and that's why.
It's not put in the drawer and then you come back in 2 months' time and let's deal with it then.
Exactly
it's
right.
Day to day.
Yeah, and the thing about options is they have a certain time frame. So they're alive for a certain time frame. And if you just leave it, then as time goes on, that option can lose value if nothing else is going on with the price. So that's why we point retail investors to more of a straightforward, plain English version of what can I do about downside limitation, or at least reducing my participation in a market fall. Don't pay too much for assets. Avoid expensive asset classes and expensive assets. That's step one. Step two is diversify. Diversify your asset classes. Diversify the type of styles that you've got going in your portfolio. And step three is if you have the technical ability and the experience and understanding to use options, you can use those as a downside limitation type strategy as well. The combination of those three things, when done properly and in a coordinated way, will certainly assist retail investors to at least reduce the amount of participation in the fall.
Yeah. And I think, we could do a whole podcast on proper diversification, because you can have a Noah's Ark portfolio too of everything in there, but if they're all linked to each other, do you have true diversification? So I think really getting into the detail of the linkages between different asset classes, there's a lot to that diversification piece. Yeah. Topic for another day, I think. So additional sources of returns you touched on earlier, and you talked about, I suppose, alternative assets, alternative sources of return. We've seen with a lot of larger institutional funds will hold big direct property or infrastructure projects, hedge funds, private equity, that kind of thing. But, not just in the unlisted space. Well, what have we got, I suppose, in the liquid alternative space? Yeah. Again, that retail investors could potentially look at, and how do you look at that to improve that return gap for investors?
Yeah, absolutely. There are a lot of strategies available to retail investors in a liquid alts allocation space. So when we say liquid alternatives, it's one of these things like investment managers like to use jargon, and a lot of that comes into it. And if you had to ask 10 fund managers, what's a liquid alternative, you might well get the old John Maynard Keynes sort of, like, you make 12 answers or something.
Correct, yeah.
But generally
you said that about economists. But anyway.
Economists.
Yeah, that's all right. No, your point's taken.
There's very much an overlap, I think, between the two. But when we look at liquid alternatives, the way to boil it down for people not familiar with it is, you're looking at asset classes or investments that have an alternative source of return to a traditional asset class.
Sure.
Right. So with an equity, shares go up, shares go down, you hold the share. It's pretty straightforward. With an alternative asset class, it's not just the exposure to a different type of asset like commodities or even volatility strategies, or infrastructure, listed infrastructure assets, and so on. But it's also a skill-based difference. So that would lead us into strategies like hedge funds or market-neutral funds, which have long and short and hedge away sort of directional market risk and so on. The reason that they're skill-based is because the market exposure is actually stripped out of them. And so all you have in terms of return is the skill of the manager or the manager's process. Now, that's important if you want a diversified source of return, because when you're putting it in a portfolio with equities and bonds, cash-like instruments and so on, it will have a lower a lower correlation and therefore a greater diversification benefit. So these type of strategies, commodities, managed futures, you do see in the retail space. They are available. Less so on the volatility side, but they certainly have come more to the market, so to speak.
The US ETFs have probably been pretty large. Here in Australia, agree, not as much.
That's right.
Offshore, yes.
Yeah, and that's a good point. You can access them as a fund or as an ETF. It's just the wrapper around the strategy. And so commodities, hedge funds, market neutral, your more stock standard infrastructure, listed property if you want to put it in there, but it's actually treated as a subset of the equity market. These are the types of strategies we're talking about with liquid alts. And also things like absolute return strategies. Yeah. So it would be absolute return bond strategies. It could also be credit alternatives. So credit being corporate borrowings effectively. Typically sub-investment grade. That's because you want to access the higher yield. These are the sort of investments that these strategies work with. But it's ways to diversify away from conventional bonds, conventional banknotes, these sort of things. All of that fits in the liquid alts bucket. Yeah,
very interesting. And again, a topic for another day is like, when do alternatives become mainstream as well? You look at things, so within the credit space or even emerging market debt, for example, it's starting to become a bit more mainstream, and it's a very interesting topic there. So we're heading towards the end of the podcast here, and we always like to finish off to get to know Scott better, what makes him tick. So finally, do you have any adage or rule that you personally use for your own investments?
There's a few. Just trying to rack my brains for the last one. one of the best ones I heard when I was in my early 20s and starting in funds management was I had a boss say to me when I was keen and eager to listen. He said to me, I don't want to make it sound like a grandfather-grandson type talk, but he said, don't ever forget that markets have a tendency to perverse outcomes.
Yeah.
And I sat there and I thought about that, and being 23, 24, it's like, yeah, whatever, because I hadn't seen any cycles and this sort of thing. But as I've gone through in my career and I work with a lot of smart people and they have the same experience, it's that don't ever be surprised by what the market will do and treat the market with absolute respect. The market does not owe you anything. It's an inanimate object. It's the aggregate of a whole bunch of human behaviours. But don't ever think that the market can't do something, because since I started...
Good or bad,
exactly, not just the bad. Because often, you sort of get out of a market and it will go north very quickly, or you want to get into a market and it keeps tracking down. But it's interesting to think back, and there's colleagues of mine have been around an awful lot longer than I have. But since 91, entering the profession in the last recession we had, if you walk through 94 bond crisis, we had the 97 Asian crisis, we had the Russian debt default, we had
long-term
tech boom bust, we had September 11, we've had a whole range of things right up to the GFC, the sort of the biggest of the lot. That's really, I think, through experience, taught me to respect markets, and it really talks to risk management. So if I had anything that I would take from my professional involvement, it is expect the unexpected and make sure that if the unexpected happens, that you're not carted out backwards in terms of your own personal wealth. And that's all about risk management.
Yeah. No, very good. Thanks, listeners, for joining us today in the Investment Series podcast. I hope the listeners gained some insights in the outlook for different asset classes and what investors can do to navigate this environment. Till next time, listeners, goodbye from the team at NetWealth.
Thanks for listening to this episode of the NetWealth Portfolio Construction Podcast Series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.